Mrinal Singh, fund manager at ICICI Prudential AMC as well, joins us on the show. Mrinal, hi, morning. What's the sense that you're getting, or rather I should ask you, are you witnessing significant redemption pressures in the past couple of months?
So, well, redemptions have not been too much. We've net had inflows and redemptions matching. So, in fact, we were successfully able to raise some fresh funds, which the market is aware about.
What about retail investors? Are they, expressing interest in the market? And if so, which sort of funds are seeing inflows at the current moment?
So increasingly we are seeing traction increasing from the retail side, and that's a good sign. We strongly believe that retail investors are underinvested in equity, particularly in a time frame like this. And we urge most of our distributors and asset allocators to increase that allocation.
Mrinal, this is your first time on the morning show, so once again welcome and a very warm welcome to you. Mrinal, if I look at your portfolio, the Prudential Discovery scheme you manage, it is a largely mid-cap oriented scheme. Mid-cap is where the real action is.
Yes.
Do you think mid-cap stocks have a long way to go?
Yeah, we believe so, particularly because when things are bad, mid-caps is where the brunt is felt. So when things do improve in the economy, which we believe should happen, then the mid-caps is where you would tend to see the improvement in the highest measure. So the stocks would also reflect that.
You are inclined towards economy-related stocks. So if I look at your last declared portfolio, you own autos, you own auto ancillaries, some economy-related businesses. So at a time when Indian economy is contracting, GDP is not expanding, interest rates are not going lower, earnings are not expanding, what is the logic here? What is the rationale behind owning economy-related stocks? Why are you not with pharma and IT?
Okay, so if you look at it, auto ancillary is a space we are very quite bullish on, particularly because we think the addressable market for those companies has meaningfully expanded. And what has also happened is that their competitiveness, which is cost per quality combination, is significantly higher to their global peers. So they will, in our belief, do well. Besides that, domestic cyclicals like some cap good companies, some power utilities, some cement companies based on geography, ex of banks. So we think they are very attractively priced. Particularly, there are some engineering companies we are able to see which at 50% utilization are able to generate decent profits. So when things look good, they would do quite well. So there are selectively still investments available in domestic cyclical space, we believe, where we are seeing that profits are being made and the outlook could be very good if things turn around, particularly where operating leverage is to be played. At times financial leverage could also help if interest rates come down.
You have a lot of mid-cap IT in your portfolio. Mrinal, you have a lot of mid-cap IT in your portfolio, Mindtree, Persistent. What's the call here? Is large cap IT expensive? Is that the reason why you're buying mid cap IT?
See, the IT per se makes a lot of portfolio sense because the addressable market, as we see, is still growing. So they are going to show a meaningful growth. And we believe mid cap IT in particular is better poised because the valuations are not very steep. So they can deliver returns in line with their earning growth, if not more. So we are definitely like mid cap IT, but that doesn't take away the fact that large cap IT is also not very steeply priced. It can be considered for earnings related growth.
Mrinal, what's the view on pharma right now, and do you think the defensive tilt of the market is going to continue and pharma will continue to be attractive, minus of course news related stories like, say for instance, Iran vaccine?
So particularly in pharma we go very selective. We don't try to buy pharma as a space, we try to buy businesses because every business has its own characteristics. So the Indian part of the pharma business generally is tracking well. The long-term outlook is good. So we have to analyze their if they are in US or some other part of the world. So we have to analyze how they are positioned for the regulatory risks, what kind of product profiles they have. So in pharma we are very selective. That's the idea, and we try to have valuation by our side. we tend to take a long-term horizon, and we continue to be invested in the names that we are.
Do you think election this time around will be more like a binary event? A stable government means markets will go up by 10-15%. Non-stable government, markets will come down by 10-15%?
Well, difficult to say, but nevertheless, market would appreciate a stable government. There are no two ways about it. And in the run-up to election, let's see what kind of expectations get built in. But then that stable government will do good to the market is an understatement here.
Mrinal, what's the sense that you're getting as to, in terms of how one should approach banks now? While asset quality concerns still remain, it's more the macroeconomic picture as well, which seems to be bogging down the sector.
Yeah, so the way we go about banks is very selective. We tend to see what kind of assets that are under stress. If the assets are basically because there is lack of demand, they are physical assets standing, then we might actually look at them favorably. What kind of valuations are on offer? If there are assets which basically are unviable, then there is a concern of high order. What kind of provisioning they've done? What is the kind of restructuring they've done, and what are they talking about on the restructuring side? So overall, on a case-by-case basis, we are selectively looking at banks. Although I agree they are a macro play to a great degree, but then the valuations are interesting. Some of them do merit investment. So that's how we're going about it.
So, Mrinal, what is your call on macro? Because sectors like auto, banks, to some extent capital goods, they are completely related to the macro environment.
Well, we believe as a fund house that we should see interest rates trickling down in 6 months or so, primarily because the inflation has become the primary focus of the RBI policy, it has been stated. And as inflation comes down, then we could expect the interest rates to come down. And that could do good to the entire economy because the cost of capital could become affordable, and then at some point we might have an investment cycle triggering in. In the meanwhile, elections would have taken place, there would be a government in order. We already are seeing that government is committed to its fiscal deficit targets. We have a spectrum auction going on, and they are going to get money from it. There has been some divestment they've done. They are sticking to the roadmap for the diesel price hike. So it should do good control on fiscal deficit. CAD is no longer a big problem. We are already seeing that currency is not under pressure. So things should improve going ahead on the interest rate side, and it could do well to the economy.
What's the view then on metals, Mrinal? Is that one space that one should look at, or are these just trading moves that one is seeing off late?
Yeah, so if you look at the fundamentals of metals, China is by far the biggest consumer of base metals in the world, and by a major number, almost 50% in most of them. So how the Chinese economy invests, because for the last 10 years or so, Chinese have been investing heavily into their physical infra, which had kept the consumption rate and the prices high for metals. So let's see, I think the numbers that we are getting from China are trickling down. So we're not very bullish on metals anymore, frankly, unless some other part of the world or an economy can compensate for that lack of demand, which we think might come across from China.
Mrinal, I noticed that you have a decent exposure to agri stocks. So you have a decent exposure to PI Industries, UPL, which is, UFOS. Is there a reason why you're bullish on agri? You think that's a tactical call or more like a structural call?
Well, we won't comment stock specific, but as a space in the entire agri value chain, we like agrochem the best, because the urea side is regulated, the production side is MSP regulated. So if you look at the entire value chain, the only free market space is agrochem and to some degree seeds. I would say agrochem is by far, and these companies have scale, they have global presence, and they are quite competitive even on a global standard. So we like that space, and we are invested into them in a meaningful way.
Mrinal, 3 months ago, the core assumption by most of the market participants was that we've got a good monsoon, which will kickstart the rural economy, vegetable and food prices will come down, and that automatically will push demand for auto, two-wheelers and other rural related industries. But that thesis has clearly fallen apart. Auto sales are still subdued, food prices have not come down. So how come the benefits of a good monsoon are not visible?
Well, that's true. I think the monsoon was good, but nevertheless, things on the inflation side for some reason couldn't moderate. The interest rates continue to be stiff, so the auto sales numbers have not been encouraging particularly. And going ahead, we do expect that could change, but for that things have to fall in place. In the meanwhile, that is predominantly the reason that we are quite bullish on auto ancillaries. I think auto ancillaries are better placed than auto to actually capture growth from the market, because they're not only related to the Indian auto cycle or the CV cycle, but they are also exporters by a large measure now. So they do have access to global markets, global OEMs in that measure, and globally things are looking well for the auto companies, predominantly in the US. So I think auto ancillaries is a better way to go about doing that investment.
Mrinal, is the cap goods space interesting you? Whenever the economy recovers, typically the sector would tend to do well, and off late the mid-cap cap goods space is seeing some traction, the likes of Voltas, or for that matter Crompton Greaves.
Yeah, that's always something that we keep a watch on. We would like to have companies which specialize in some things like mechanical and electrical side of things. Particularly if they are not carrying too much leverage, they should be able to see through the downturn. And when things do look up, they'll be better placed. So yeah, obviously cap goods is an interesting space, particularly as long as the valuations is by our side and we can get comfortable leverage. Leverage is a that most cap good companies have. So if we have manageable leverage and good execution skills, we would for a valuation consider them.
ACC and Ambuja are holding out ahead of their earnings today. Mrinal, is cement as a pocket something that interests you, or would you rather stay away because it's been so beaten down?
So well, in cement we take a geographical approach. We tend to try to make forecast or research around what could be the demand in a region and what are the assets that companies have in that region to cater to that demand, rather than, and then we narrow down on, based on the geographical presence of those assets, how they could pan out. Yeah, cement is interesting. There are no two ways about it, and we try to take a geographical approach around cement.
But I don't see cement in your portfolio.
Because it's a commodity. So yeah, I mean, we're evaluating. There is very little as of now, and some things are on horizon. So
there is value in this market.
You mean the cement?
No, I mean, in this entire market, where is value? I mean, if I have to, let's say, compel you to give me some ideas, some themes which offer deep value, what are your ideas?
Well, I mean, if you look at our portfolio, which is public, you would get a sense where we think value is. Clearly, domestic cyclicals is something we think offer value. There is value, as we talked about, in mid-cap cement also. Particularly in mid and small cap, there are very interesting valuations around across sectors. Those could be sectors which on the large cap side are steeply valued, but on the mid cap side they are still interesting. So for that value to unfold, the important thing is investors, we strongly urge, should have a horizon, because when you get into mid and small cap, there is volatility of a higher order. And the way to deal with volatility is to have a longer horizon, and things when fall in place on the macro side, the value will be unfolded and returns would be consummate. This is what we've seen in the past also. This is what we believe should happen going ahead also.
Domestic cyclicals is the big idea from Mrinal Singh. It was great to have you on 80 Now, and I certainly look forward to more of you going forward.